It's the Real News Network. I'm Sharmini Pires coming to you from Baltimore. For a long time now, mainstream economists have argued that for a developing country to develop economically, it is necessary for the country to seek foreign investment, or FDI, foreign direct investment, as it is usually referred to. In other words, developing country governments should seek to make their countries attractive to foreign capital in order to acquire the FDI that will allow the country to develop economically. This would mean a low tax burden and as little regulation as possible for investors. With us to discuss the findings of a recent study on the topic is Leonce Ndikunuma. Leonce is a director of the Foreign Policy Program at Political Economy Research Institute, known as PERI, and co-author of Capital Flight from Sub-Saharan African Countries. And if you wish to read further about the study, you will find a direct link to it just below the player. Thank you so much for joining us, Leonce.
Thank you very much.
So, Leonce, let's establish some context as to the study. First of all, what are the debates in economics that are going on in terms of FDI, and what is the debate first?
Yes, so thank you very much for the opportunity to talk about this study, which is a joint work with my colleague Marsar, Professor of Economics at the University of Cape Town. And it's a study that we did in the context of a broader project by the UN UWIDER that's trying to look at various aspects of development linked to the management of natural resources. In this particular case, the context is that if you look at the past 3 decades, mostly the past 2 decades, what has been happening in African countries and other developing countries is an acceleration, clear acceleration of foreign direct investment into these countries, mainly directed to natural resources. At the same time, we have seen, especially since the turn of the century, an increase in growth rates, economic growth rates in these countries. But again, at the same time, we see a stunning paradox whereby as more capital is coming into African countries, there is an acceleration of capital fleeing the continent. So capital flight has accelerated in the past 2 decades, even as economic growth has increased and foreign direct investment has increased. So that prompted our interest in looking at the interplay between the 3 phenomena. One, the fact that FDI has increased over the past 2 decades, and that capital flight has also accelerated, but also that the fact that the growth acceleration has been driven by the resource boom. So you have seen resource-rich countries benefit from commodity price increases prior to the recession, even after the recession, although now we are in a phase of decrease in commodity prices.
Give us some examples of the kinds of foreign direct investments that are taking place in the area of natural resources.
Yes, so we have heard and read about the fact that natural resource-rich countries in Africa, countries rich in oil, minerals, have attracted a massive amount of investments from both traditional partners in the West, Europe, US, but also what we call emerging partners in the emerging markets, China, Brazil, India. We have heard about the stories about big, massive investments, for example, in the Democratic Republic of Congo by China in exchange for construction of infrastructure. So China gets access to mineral mining concessions in exchange to building infrastructure. We know the oil-rich countries like Angola have been prime destination of investment from China, but also Nigeria, one of the biggest oil producers in the continent, even in the world, is a major destination of foreign direct investment. At the same time, so we have a clear case where natural resource rich countries are prime destinations of foreign direct investment. But the same countries I mentioned, Angola, Democratic Republic of Congo, Nigeria could add Congo, Cameroon, are also countries that feature prominently on the list of high capital flight. So that prompted our interest in looking at the linkages between capital flight and FDI and whether this may be intermediated by natural resources.
And give us some highlights in terms of your findings.
So the main findings are quite interesting. Yeah, as we would have expected, we see a positive relationship between capital flight and FDI. But interestingly enough, the relationship varies depending on whether we look at the annual flows of FDI or the stock of FDI. This is basically a follow-up to our analysis where we have looked in the past about the linkages between capital flight and external capital inflows in the form of external borrowing, where, especially with my colleague Jim Boyce, we have found that external borrowing tends to fuel capital flight in the sense that some of the money that's borrowed by the countries ends up financing capital, ends up leaving capital flight. So the question here, it ends up leaving the country. So the question we pursued here was whether FDI behaves the same way. Is it the case that annual inflows of FDI lead to annual outflows of unrecorded capital or capital flight? We find that relationship is weak in the case of FDI, so that there is no contemporaneous positive relationship between capital flight and FDI. But we find a very, very strong relationship between the stock of FDI and capital flight, which prompts us to think that the relationship between FDI and capital flight may be indirect. And here we look at the indirect linkage channel, which may establish this linkage between capital flight and FDI, and we look at the role of FDI, of natural resources. So natural resources clearly in our analysis lead to capital flights in the sense that countries that are heavily endowed in natural resources also are exposed to high capital flight. This link can be direct in the sense that the revenue from natural resources are embezzled and channeled out of the country clandestinely into secret destinations that are in the form of private wealth. The relationship could also be indirect in the sense that endowment in natural resources creates incentive for rent seeking on both domestic leaders and investors. And this is especially important in the case of African countries, where we see that natural resources are dominated by foreign multinational corporations. This is different from other regions. For example, if you look at even the Middle East, in the Middle East, the majority of oil exploiting companies are actually owned by nationals or governments of these countries. That's different from Africa, where the majority of multinational institutions are foreign, which creates a channel for not only tax evasion, but also the siphoning out of the revenue from natural resources and out of the country in the form of capital flight. It also creates opportunities for rent seeking on the part of governments, especially because of the high degree of discretion that the governments enjoy in the management of natural resources. So in a country where you have bad institutions, lack of transparency, that leads to risk of corruption, rent seeking, which would then establish a mechanism for channeling of wealth out of the country in the form of private assets. So that explains why we would find this high correlation between the stock of capital flight, the stock of foreign assets, foreign FDI, and capital flight in countries that have high natural resources. The third finding is that comes out of our study is that good quality of institutions tend to mitigate this positive relationship between FDI and capital flight. And that, again, our suspicion is that it's because in a country which is led by governments that have good institutions, transparency, accountability, that would reduce rent seeking in the natural resource exploitation. That would reduce tax evasion. That would reduce smuggling of private wealth out of the country, and therefore minimizing the likelihood of FDI promoting capital flight, which has some interesting implications in the sense that if for countries that have high natural resources, for them to benefit from these natural resource endowment in terms of promoting development, they will need to establish good, transparent institutions that enforce accountability and transparency in the management of revenue from natural resources.
Right. So then, Leonce, if your research establishes a correlation between FDI and capital flight and cannot establish a definite cause of capital flight, speculate for us why there's a correlation between FDI and capital flight. What might be causing capital flight?
The correlation basically says that where we find high high FDI, we also find high capital flight. That could be because, as I indicated, when we look at the countries that attract the most FDI, it's also the countries that have high natural resources. But unfortunately, sadly enough, in the case of African countries, the countries that also feature prominently in terms of high natural resource endowment also feature prominently in bad governance. Therefore, you have a corrosive environment where natural resources are exploited in an opaque environment and therefore generate revenue which is appropriated by the leaders or their private associates, and ends up being channeled abroad secretly outside of the official capital account transaction established by the government. So the sense we make out of this result is that bad governance in countries with high natural resource environment establishes that positive linkage between FDI and the capital flight, whereby because high natural resources attract FDI, bad governance establishes creates incentives and opportunities to embezzle the proceeds of natural resources and channel them into foreign private wealth held abroad in the form of capital flight.
Right. All right, Leon, so this seems to me a good place to pause, and then we can come back and discuss what are the policy implications and what could be done to correct this. So thank you for joining me for now.
Thank you very much.
And thank you for joining us on the Real News Network.